All right. Well, hello, everyone, and thank you for joining us today. My name is Samantha Johnson, and I am the Assistant Director of Alumni Engagement here at the University of Colorado Boulder's Leeds School of Business. Leeds is a top business school offering undergraduate, MBA, MS, and PhD programs, and has an alumni network of over 41,000 strong living and working around the world. We're excited to have Rich Wabakind presenting on the economic outlook for 2019 today. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Rich, please send those questions through the question and answer interface. We will monitor questions as they're submitted, and Rich will answer them at the end of the presentation. You will also be able to view the questions. You can comment on questions that are submitted, and you also will have the opportunity to upvote questions if the question is similar to one you have or it's one that you want to be sure is answered today. Also, as a reminder for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through your chat interface and one of our support specialists will touch base. One note, upon leaving or exiting the webinar today, you will be prompted by the Zoom interface to visit an external website which will take you to a brief feedback survey. Your feedback helps us drive future content and speakers, so thank you in advance. And lastly, a link to access the webinar recording will be sent to all registrants tomorrow. So now, I'd like to introduce today's speaker. Dr. Richard L. Wabakind is Senior Economist and Associate Dean for Business and Government Relations at the Leeds School of Business. Rich teaches MBA students in macroeconomics, public policy, and entrepreneurship. He has received 4 awards for teaching excellence from the students of the Leeds School of Business. Rich has lived in Colorado for over 40 years and has spent much of his time studying the development of the Colorado and regional economies. Rich received his BA in economics from Bucknell University and an MA and PhD in economics from the University of Colorado Boulder. Welcome, Rich, and thanks so much for being here.
Well, thanks for having me, Samantha, and thanks to the audience. Appreciate you joining us for the next roughly hour and to talk about the economy. I'd like to, first, before moving into this, I'd like to just address the very first slide. It is the 54th Annual Colorado Business Economic Outlook. And for those of you not familiar with how this is constructed, annually we use a panel of 110 business professionals who cover the various sectors of the economy to help us put this together, the 2019 forecast. We in the Business Research Division do both national and state econometric forecasts. So we have a lot of sort of the standard statistical background behind the forecast, but we use this to enrich the qualitative content in the various sections of the report. And this is reflected in the actual booklet, the cover of which looks like what you see on your screen at this point, and will be accessible in its entirety on our website, or is currently accessible in its entirety on our website. We will send that. I think Samantha will be sending that to you in the follow-up email. She'll give you the link to that, but it's also, if you Google Colorado Business Economic Outlook, you will go directly to that page. So you can look in much more detail on the sub-areas that you might have greater interest in. We also have a continuing, you see a hashtag on this page, Colorado Biz Outlook. We have a continuing conversation on economic issues at that particular hashtag. We'd love to have you to participate in that, not just with this webinar piece, but whenever you see something interesting on the economy, it's really a focus on the overall economy that we're trying to continue to engender. So I did a presentation this past summer, and it was a time when everything was riding high. And I spoke to the audience a little bit at that time and said, what we're seeing out in the future portends the economy slowing in 2019 and even further in 2020. So if you're using this information for business planning, I would encourage you to think a little bit more about this in terms of 2020 being a little bit slower time, and build that into sort of your longer term view. I was almost booed off the stage. No one wanted to hear the recovery might end at some point. And in fact, a lot of the people, when I said, do you believe the recovery will ever end? They put their hand up and said they didn't believe the recovery was ever going to end. So that changed the title of my talks after that to Will the Recovery Ever End? Or When Will the Recovery End? And more recently, as we've seen some of the issues related to the elephant in the room. And the elephant in the room, of course, is the business cycle. When might that happen? And what might be some of the causes of that? So that is a quick, hopeful background of setting up the forecast. I'll give you my views or our views and opinions on some of these things. But our overall view is really quite positive, continues to be positive. We do think that GDP growth is going to drop in 2019 to the 2.5% range, 2.4. This, of course, is being influenced on a daily basis with the government shutdown, so it makes it even more difficult to come up with a, say, precise forecast until we know when this is going to end and what economic damage in terms of GDP specifically it might be inflicting for the longer term. But nonetheless, GDP growth in 2018 exceeded sort of the long-term sustainable pace, driven, as you know, by the tax cuts and economic stimulus package of the government. It was fine. It increased employment, and we got good output increases. But as we go forward, the long-term sort of trend rate, what we used to refer to or still refer to as potential GDP, is much closer to 2.5% than it is to, say, 3.5%. So we really need to be mindful of that as we go forward and think about what normal is. If you want to say what is a new normal, the new normal is really much closer to 2.5%. And further, it looks like 2020 will be going down into sort of the 2% range or sub 2% range as we enter even further levels of economic slowdown. So the economic growth that we're looking at, the key sectors, of course, are consumption, investment, government spending, and exports. And you can see the contribution of these various sectors. I am going to address them in a little bit more detail, at least a couple of them, in a few more slides. But you can see how each one of these has been helping the GDP growth or not on a quarterly basis over the last 18 years, going into year 19 as we speak right now. So when we look at the consumption expenditures, we had 1 weak quarter, the third one from the right, when we're looking at the upper left-hand graphic. But the consumer has been pretty much the hero. And when we talk about recession or no recession, the consumer remains an extremely key point of whether or not that's going to happen. And right now, the consumer is looking pretty good, continues to be strong in the economy. Again, a little bit more discussion about that in a bit. Business investment in the lower left-hand quadrant had been pretty strong, and some of which probably related to the tax cuts, some of which related after tax or profits. So we have, more of an ability to invest, but the most recent quarter showed a kind of steep decline in that. And that, of course, is one of the things that people have been pointing to, saying perhaps the slowdown in business fixed investment and in the housing sector really are portending slower economic growth, be it a recession or just slower economic growth. Upper right, you can see government spending has been a big contributor over the last year to the more robust GDP growth, and net exports has netted out to be slightly negative. It's a little difficult to maybe see from this particular graphic. We had a period where it got a little bit better as some of the soybeans and other things were exported early, but now it appears that it's going to be more of a detractor from GDP growth going forward. How is this sort of related to the overall employment picture? Certainly, a year ago when we were talking, and we did the webinar and we were talking about our release, we were anticipating slower job growth, both nationally and in Colorado, for 2018. And as you can see from the graphic, we were not right. We saw faster job growth in 2018, both nationally and, as you'll see a little bit later, also in Colorado. This in a relatively tight or very tight labor market, depending on your definition of tight, and somewhat surprising. At the national level, maybe a little bit less surprising because of the tax cuts and stimulus package, some of the things that led to this higher GDP growth, and at the national level, a higher unemployment rate than at the state. So when you put those pieces together, there was more slack, if you will, at the national level. When you'll see the state data a little bit further in the presentation, you will see that the state had a lot less slack. So it's interesting that the state was also able to have increased employment growth in 2018. All of that said, the effect of the tax cuts and other stimulus pieces wanes in 2019 and further in 2020. So we are anticipating slower growth. This is not no growth. This is just slower employment growth throughout 19 and into 2020. Colorado is one of the states that's really fared particularly well. The darker the color on the screen, the more rapid the growth has been in terms of employment growth. So you can see we're not growing as rapidly, for example, percentage-wise as Nevada, Arizona, or Wyoming, but we are one of the top 10 states in employment growth. You can also see that there are a couple of states that are actually negative, Vermont and Alaska, to be specific, and some that are stagnating in the Midwest and in Maine. So we have variations amongst the states, but a lot of states have seen solid job growth, and many states have low unemployment rates. So the national economy still looks quite healthy when you put it into general context. That has led to very low unemployment rates. As you can see, the U3, the bottom tan line on the screen, 3.9%. That's the more frequently quoted headline number that you see in the newspaper. So under 4%. You can see we're at record-setting levels going all the way back to 1994 on this slide. So it even goes back much further than that. So this is a very, very low unemployment rate. And consistent with that, you can also see the U6, the underutilization, the part-time workers who want to be full-time and so on, is down at 7.6%. It is not quite as low as it was before the internet recession, the internet bubble burst in 2000, but it's lower now at this point than it was going into the 2008 recession. So not a lot of slack in the labor force, not a lot of people that you can be pulling in to the labor force unless you get people to increase their participation. And this is so in the previous slide, if you look at this for just a second, these are people who would like to work more hours, or these are the people who are in the labor force who don't have a job, the 3.9%. When you move to the next slide, it's people who are not in the labor force, who maybe we could increase their participation into the labor force. And this is one of the things that is a kind of an overriding principle of supply policies, tax cuts that you hope in the end game are going to increase labor force participation. So people are going to come out of the sidelines because their after-tax income is going to be higher. They're going to feel better about life. So we're going to bring some of those people back into the workforce. And it is happening. If you look at this slide, it's happening somewhat significantly in Colorado, but we haven't seen it happen very much at the national level. And in fairness, it's the supply side kind of policies. At the same time, you have demographics working in a pretty bad way in terms of labor force participation, or negative way, if you will, in terms of labor force participation. So we look at the picture here and reflect into the next graphic, which is looking at labor force participation through 2018. The last two bars, the numbers aren't quite available in 2018 yet, but you can get the sort of sense here. What the tan is showing you is the historical peak for participation in each of these age groups. And then what you're seeing in the red bar is the current 2018, or as much as we have of 2017 for the last two categories. And what we see in this particular picture is the 55 to 64-year-olds and the 65 and above are at very high participation rates compared to historical norms. 65 and above is at an all-time high, but as people are moving rapidly into those brackets have lower participation rates than 45 to 54, 35 to 44, 25 to 34. So those second, third, and fourth columns, if you will, are below their all-time peaks, and certainly are part of the issue. A big issue, you might guess, is in the very first column. 20 to 24-year-olds, for whatever the reason, they're continuing to further their education, they're traveling, whatever it might be. We have significantly lower participation rates there than we've had at previous peaks. So the challenge is getting really the people in the prime working age, 25 to 54, getting those categories up to peak, and then also increasing the participation from the 20 to 24-year-olds. So that's where the labor force is going to come from, or needs to come from. And with a continuing expanding economy, and again, a low unemployment rate, we're hopeful that we will see some increases in participation at the national level. So dropping back now for a moment to these key components, consumption to start with, 70% of the economy, and again, harbinger of whether or not we're going to go into economic recession. How are the consumers behaving? Are they slowing down? Are they nervous? Well, so far, not so much so. We've seen real disposable income at pretty healthy levels in terms of real disposable income growth. Not surprising with the strong employment growth we've seen in the country. And we've seen consumption, as I highlighted earlier, real personal consumption, the right-hand graphic, growing at a very healthy pace, over 2% and even slightly over 3% one year, but well over 2%. While the economy, most of those years, was growing at 2%, 2.2%, those kinds of numbers. So growing faster than the overall GDP and really helping carry GDP growth. Amongst other things, of course, the income is going up based on the employment. So they have ability to consume, if you will, based on income levels. But when we're looking at other ways that households could be consuming, certainly wealth is an important part, be it real estate, corporate equities, mutual funds, or other assets in retirement funds and so on. That amount of wealth accumulating certainly helps the general household consider purchasing, either feeling more secure about their future so they can consume out of current income, or actually consuming out of that wealth by taking out loans against retirement accounts or home equity lines against, say, the real estate that they own. So this is trails, of course. We don't have the fourth quarter on here, and likely will have a significant dip because of the second, third, and fourth categories. Real estate is continuing to appreciate nationally, but not the other asset categories. So we will see a little bit of a decline, and it is an area where people are paying attention. If we were to see asset values to continue to decline, will that eat away at the psyche of households, maybe more so than their actual ability to consume? They have the financial assets, they have work at this point in time, they have income, they have wages rising, something I'll talk about a little bit later. So we see a lot of these things happening. And when we look at the debt that households are carrying in terms of ability to consume, whether it's out of income, wealth, or debt borrowing, we see those numbers again at very low levels, not quite at historic lows, but very close to historic lows. This is the amount of monthly payments as a percentage of income, personal income that a household has. So these debt service ratios, financial obligation ratios are very low in historical context, meaning, I guess, at one level that there's ability for consumers to continue to expand based on credits, auto loans, or other types of things if they don't have the actual income in hand to make those purchases. So even with the higher interest rates, we still see the debt service ratio at very, very low levels. All of that is in the ability category, but at the end of the day, they have to be willing to consume. You can see we've had a tremendous run up since the 2009 time period. The red is the United States Overall Confidence Index. The blue is the Rocky Mountain region, which includes Colorado. That's the subcategory. And you can see there's been a strong run up, but in the most recent month, we've seen a little bit tailing off in terms of consumer confidence. What happened in the stock markets, especially in December, appears to have had an influence, again, on the psyche of consumers. But still, these levels are very high levels. You can look back historically. We haven't been at these levels very many times in the last 30 or 27 years. So this is still a very high confidence level overall. And sort of the major things that we would look at for is how does the consumer feel about life? Most recent pieces have been vehicle sales. The December number was quite strong. This is over 17 million again. It was the strongest four-year run in vehicle sales that we've seen, and also retail sales, even though we're anticipating retail sales nationally to drop a little bit, we continue to see strong retail sales. I would tell you, we know we had a good holiday season. We think we had a good holiday season, but of course the retail sales data is in lockdown with the government shutdown, so we actually don't know how good or the holiday season was, but many retailers seem to think it was a very good season. So moving along from consumption onto investments, and again, our discussion of the national macro economy, corporate profits and business investment, extremely important. This is, future growth, way of thinking about future growth. And we did see in 2018 a big jump up in pre-tax corporate profits, and of course even a larger one if we had shown you a graphic with after tax, because the tax rates decline. So we see a nice rise in pre-tax corporate profits, and this year forecasting still a 5% increase in pre-tax corporate profits. So that's a solid number, and that has led to solid business investment in 2018, and we think again another decent year of business investment, not a dramatic one, not an overly impressive one as we saw in the recovery after the recession, but still strong business investment in the 4+% range. We see this as a positive, even though the business confidence indexes nationally, and later on you'll see the Colorado index that we do, the indices have been coming down most recently from very lofty levels. You can see the manufacturing index on the left had hit almost an all-time high back in a few months ago. Now we've seen it come down to the 54 range, and the non-manufacturing index also declining, but still up in the sort of 57 range. So we've seen, the confidence levels fall in the business sector, and we attribute this, frankly, to the great degree of uncertainty that's out there. There's a wide variety of uncertainties. The stock market perhaps is reflecting that, but there's the trade uncertainties. There's issues around global growth. There's issues around interest rates. Now there's issues around government shutdown, and that's impacting the private sector, at least on the most recently written articles and news broadcasts. There seems to be a discussion of how much that is starting to affect the private sector. So the combination of those things has really weakened confidence, even in spite of coming off a year of 3+% GDP growth. We're starting to see a little bit of concern about what the future holds in both the manufacturing and the non-manufacturing index. I caution here for a moment. The red line is neutral. Below the red line is where confidence, it was contractionary. Businesses were indicating contraction as opposed to expansion. So you can see the 2001 and the 2008 recessions where confidence dropped well below the 50 mark. Even though we have seen a decline in confidence on both of these graphics, we are still looking at a number that's in the growth, but perhaps slower growth, or the slower growth category when we look at the overall picture. Moving along, we are looking at other parts of investment. So it's not always clear to the person on the street, I would say. But when we talk about investment in the overall picture, we're looking at the not only business investment, what we call business fixed investment. You can think of warehouses or commercial buildings or retail investments. You can think of machinery, but we also talk about software investments, so on the business side. And then in addition to that, we talk about residential investment. So this is where home construction, both single and multifamily, comes into the picture. And one of the areas that we are following very closely is looking at the home prices and whether or not this will continue to support further growth of the housing sector, whether this is perhaps limiting some of the growth of the housing sector because of affordability. You can see from the FHFA home price index slide that is on the screen right now, Colorado remains one of the top 10 states for home price appreciation. I'll show you something at the end that will be a little bit more staggering than this particular slide, but Colorado continues to be a state that is addressing some of these home price affordability issues. It's part of the problems that we think might constrict the state as we go forward in terms of economic growth. So this is one of the questions about future growth and sustainability of the state, both in terms of economic affordability and other types of things. Maybe get a chance to address those in more detail a little bit later in the presentation. So you're seeing the overall picture here, and what we do see, by the way, I don't have slides on all of these things, but housing construction numbers continue to be well below the long-term trend at the national level. So we still see nationally an underbuilding, although we are estimating that home prices have started to rise less rapidly nationally, and we think that trend will continue. We're still going to see home price appreciation at the national level, but we're not going to see it be as torrid as it has been over the last several years. Looking at the federal budget, this is a slide that is not pretty, to be blunt. You can see prior to the 2008 recession that through that entire cycle, the 2001 recession, You can, if you look at 2001, you can see that the deficits got greater for a period of time. And then as the economy went back into recovery, the deficits got smaller. And then you can see what happened in 2008. We went into the next recession. Deficits got dramatically larger. And then over time, they have gotten smaller up through 2015. And now as we go forward from 2016 forward, in terms of the government's fiscal year, we're seeing these deficits widen, and the projection for 2019 and frankly for 2020 is over $1 trillion deficit. So it's not typical to see deficits widening at the while the business cycle is still in expansion. Usually you get into a little bit healthier scenario, and then you start to see you see the deficits widen when you move into this sort of next economic downturn. This, I think, argues, at least in our minds, that this is a situation that will give the federal government, legislative, the president and the House and the Senate, a little bit less ability to address an economic downturn just because of the existing situation in terms of the federal budget deficit. International trade, also the global slowdown. You can see the important destination partners for exports for the US. And when we look at the broader picture here, the trade-weighted value of the dollar, it has come down a little bit. It's sort of bouncing around. But we have seen the value of the dollar as one of the things that's sort of constraining trade. Or limiting trade to some extent. Obviously, the other piece is the removal of NAFTA and now the renegotiated trade agreement with Canada and Mexico. Important trading partners for the U.S. and for the state of Colorado. And then also the continuing issues with the tariffs and trade with China. So these are pieces that, in our opinion, need to get worked out for the overall health of the economy. Understand the concept of perhaps specifically even with China, that you're trying to negotiate to level some playing fields that you may feel are not level. Canada and Mexico, those fields were probably not as uneven as maybe the China trading field was, a personal opinion. So very important to get those trading agreements back in place, and the new Canada-Mexico agreement helps, but we still have some tariffs in place that are impacting our trade numbers as we speak with both Canada and Mexico. Money, interest rates, and prices. So where are we here? I know a lot of people are interested in this particular category. Well, you can see that dampening, although the the graph that you see in front of you indicates, in our opinion, no a flattening of the yield curve, but not necessarily a movement to inverted yield curve at this point. As we see interest rates move forward in sort of a very modest way, including the 10-year note and 3-year bill, the bottom two, but also the 30-year conventional mortgage. So you can sort of see the general view of where we think interest rates are going. This has, of course, been dampened lately by the view of the Federal Reserve. After 4 rate hikes in 2018, including the December meeting, we now have various people discussing the potential of delaying additional rate hikes, or maybe even not having additional rate increases in 2019. So to give some context for the people who don't follow this closely, as recently as a few months ago, or say 5 months ago, we were talking about 3 rate increases in 2019, June, September, December, and we pretty much had not thought there would be an increase in March again, that there would be a little bit of a give it a chance and let's see what's going on with the economy. That number maybe 2 months ago, I think consensus-wise came down to 2 moves for the year from 3 moves for the year. And again, loaded in that far end of the year so that we can see how healthy the economy is. And this particular graph, if you're not familiar with it, is called it's the Federal Reserve's dot plot, and it charts the 12 voting members of the Federal Open Market Committee, where they're thinking the rates will be at the end of the year, 2019. And the larger the dot, there's more people in that particular dot, and also describes who they are a little bit, but we don't need to worry about that. They're all voting members, and you can just see from March through September and then December going across, you can see what they were anticipating or expecting. And the big thing I think to take away is that when you look at the December meeting, the highest sort of number there is sort of in the 3.25 range. We're currently at 2.5, so that would be 3 rate increases. But you can also see the little tan ball at the bottom is actually probably looking like a rate decrease, one rate decrease. So they're definitely looking at 1 or 2 on average increases for 2019. Former Chair Yellen just came out earlier in the week, Janet Yellen, and said that she thought that we might not need any more, adding her voice to some of the more dovish positions of the Fed. She has historically been a little bit more in the dovish category. But as recently as yesterday, Esther George, who is the president of the Kansas City Bank, the Kansas City Bank is traditionally much more hawkish in terms of higher interest rates and monetary tightness. And she came out and said that we should definitely be on hold for a period of time. She didn't eliminate the possibility of rate increases in the second half of the year, but she said in her comments yesterday that she anticipated there wouldn't be much of anything in the first part of the year. So even the more, historically at least, more hawkish members of the Fed are looking at taking a little bit more wait and see attitude. This has, of course, been fueled by this ugly graph you see in front of you right now. This is the volatility of the various pieces of the market, the Russell 2000, S&P, Dow Jones, etc. And I guess 2 things to take away is how jagged these lines are. We indexed this particular graphic back to the beginning of 2018. The first trading day equals 100. So you can see, looking back at 2018, that if you go across to the right, even at the very end, even with the kinds of upticks we've seen recently, you can see that we're still 6% below or so in terms of the Russell 2000. Well, the S&P is still 4% or so below what it was the beginning of January a year ago. And the only one that's really close, or the closest of the group, is the NASDAQ, only 1% or so below what it was, again, January 2nd of 2018. So we have seen over that period a clear, loss of value, and that, of course, is part of the market turbulence, is part of what the Fed is looking at in the background, but also part of the concern about consumers perhaps moving away from their current consumption patterns a little bit and adding a little bit more instability to the marketplace. We look at the general sort of condition of credit as we're looking at this particular piece, and we need to, we can see that the condition of credit is such that student loans are ticking up a little bit, but overall, and we also see, by the way, a little bit of its uptick in auto delinquencies. But the punchline on this particular graphic is most of these have been in a decline mode. maybe slightly increasing, but all seem relatively stable. I'm going to pick up the pace a little bit as we go into Colorado, but simply talk about inflation in the economy at this particular point in time is fairly benign at the national level, but one of the issues has been in Colorado that we've had higher inflation rates than the national. The 2018 numbers are finally looking like Colorado is coming more into line with the national numbers after having much stronger inflation between 2013 and 2017. So what about Colorado? When we look at the population change, we continue to be growing as one of the top 10 fastest growth states, roughly 1.4%, so nowhere near the rate of growth that we have seen in the recent past, or certainly not back in the 1990s, but still strong population growth and roughly twice that of the national average. This has enabled us to bring more workers into the state. As I suggested, we believe that when the sun sets, we're going to see a little bit stronger job growth in 2018, not what we forecast at this time a year ago. We forecast a slight decline in job growth in 2018, and we are continuing to forecast a downward trend for 2019 to 53,000 jobs, roughly a 2% job growth rate. Much stronger job growth rate than the nation. Again, a top 10 state in terms of job growth. And job growth is dispersed across every sector. Somewhere in one of these sectors, if you're working, you're in one of these sectors. Be it public or private sector. The biggest ones are professional and business services, down on the left, the biggest contributors in terms of total numbers of jobs. This is a sector that holds a lot of the high-tech workers, so it's a kind of a tech move. The third one up is leisure and hospitality. This really captures most of the tourism sector. And then you can see others, including all the way up at the top, a very tiny slice, natural resources and mining. This is oil and gas, lumber, all of the natural resource industry in the state, adding not very many jobs in terms of absolute number, but the percentage increase there is quite large because the employment base in natural resources and mining is pretty small. This growth has been not even when we look around the state of Colorado at the various pieces. We've seen growth much stronger in the Northern Territory, Weld County with Greeley, and Larimer County with Fort Collins and Loveland have been extremely hot areas. A very diversified economy when you put those two pieces together. Oil, gas, construction, agriculture, high tech, renewables, two fine universities. We could go on. And then you can see the growth as you go down, the national number and how much higher Colorado is overall than the national number. And then trailing a little bit, Pueblo and Grand Junction. I will highlight that Grand Junction has been on a very strong run over the last year, as has Colorado Springs. You can see the Colorado Springs curve has been upticking quite a bit. So we have seen some nice movement in that regard. We also see very low unemployment rates overall, 3.4% in the state. And how did we get this job growth with such low unemployment rates? They were even lower. They were down at 3% earlier in the year. Actually in the high twos. The answer is we had that increase in participation rate in addition to the in-migration to the state that I mentioned just a moment ago. So overall, Colorado in 2018 growing at 2.6%. And that is leading to also overall wage growth in the state, at least through the middle of the year, that it's quite positive, 2.9%. But we would hope that those numbers go even higher in terms of the percentage increases. Nationally, for the most recent month, wages are up 3.3, 3.4%. So we're hopeful that this is a lagging data slide for the Colorado wages. We're hopeful we're going to see a bump up there as well. Moving along, we want to look at agriculture, and just a quick comment on that. It's been a tough year for agriculture in Colorado. We anticipate another difficult year. Commodity prices are low. In addition, they're battling drought and other conditions in the state. So really, someone asked in their questions about climate sustainability. We certainly see impacts from that in both the tourism industry and in the ag industry. Natural resources and mining, again, strong drop off with the oil cycle. You can see the black part on the bottom. And now we're starting to see more significant increases in terms of oil price bounce back, and overall we're going to be looking at another strong year in terms of overall natural resources, at least fossil fuel based natural resources. But we're not just a natural fossil fuel based state. We have a very strong renewable portfolio, one of the most ambitious renewable energy portfolios in the country. Wind, solar, and hydro, as you can see from the slide. We're ranked 10th nationally for wind capacity, 12th nationally for solar. And for those of you not from Colorado who might be listening in, there's been a large announcement from Xcel Energy, the major energy company in the state, to go major conversion to more and more renewables over the next 20 plus years as we go forward. There's been quite a bit of increase in the last couple of years in terms of net generation in 17, a little under 20%, over 20% in 18. It will be well over 20%, we believe, in 18. So we've been moving more into the renewables realm. Construction, always one that people are interested in. So again, some quick comments here, looking at the time. Colorado's home prices, not quite double digits, extremely strong home price increases. And this has been throughout. You can see that when you get a chance to look at these slides in more detail later on, you can see Colorado's various areas of Colorado, the average compounded average growth rate, 5.1% for the last 10 years. And you can see every place participating in that. More recently, Grand Junction, which had been in quite a long, prolonged housing slump, but you can see all areas of the state. So this is for the last 10 years, we've averaged 5% increase per year. And of course, that includes the recession of 08 and 09. Part of this is driven by the fact that our supply and demand seemingly got out of whack. The tan is the households, tan is households, and red is how many housing units we've been building. So you can see for a long period of time, about an 8-year period of time, we were underproducing housing, and that has led to very strong increases in housing prices and extremely high increases in rents for a period of time. The rent growth percentage-wise is in red on the red line on this particular graphic. You can see we were in double digits for a couple of years. Now we're down in the 4 to 5% range most recently. So the additional housing that we've been putting online, which is reflected in the next slide that I'm going to show you, this additional housing has helped in terms of slowing down, if you will, the housing price appreciation, but particularly slowing down the appreciation in terms of rental properties. We've been building a lot of multifamily for rent, and that has helped the overall picture. So overall construction, again, is strong. The non-building at the very top, infrastructure, might be a little deceptive. We have a lot of work going on in that area, but it was permitted in 2016, it was permitted in 2018, so it doesn't show up. This is what we expect permitted. We see non-residential, commercial still relatively healthy, but especially with the warehouse continues to be a big piece. And as I mentioned, residential. So looking at the last couple of sectors of that we're going to focus on for this, and leaving a few minutes at least for Q&A. Hospitality and leisure, we continue to be an extremely strong quality of life state, and also public lands visits extremely important, and we have continued to have very strong growth in that. Of course, a lot of that is summer tourism. So you combine the summer tourism with the winter tourism of skiing, and you wind up in a very, very strong position. This is very healthy, and combine that with the airport, which continues to perform at a better and better rate in terms of number of flights annually. You start to see this is 64 million employments and deployments in 2018. We are forecasting an increase in 2019 as well. As of last month, we believe we have the most domestic destinations of any U.S.-based airport. We were second last year, but we appear to have passed Dallas-Fort Worth for the most destinations, direct destinations from the airport. And perhaps more importantly, getting more international flights. In the last 2 months, United Airlines has designated DIA as a Dreamliner hub and has added direct Dreamliner flights to Heathrow and Frankfurt, in addition to the Dreamliner to Narita that has been in place for several years. All of this coming to a close here. Retail sales, modest increases, 5%, healthy growth. That helps, of course, local tax collections in Colorado, but also state tax collections. And we see the general fund continuing to be healthy in terms of overall financial position. This is great. Probably will lead to Tabor rebates. We've had our recent election, for those not in the state, wound up being a Democratic Senate, Congress, Senate, House, and governor. So there have been some discussions about whether or not that will have specific industry impacts, or whether or not there will be attempts to do something with the Tabor rebate. I don't know how easy that will be to do, but there have been articles and discussions in the newspapers that there may be some attempt to do that. It's something that as business people, we're paying a lot of attention to see what kind of potential changes might be on the horizon. Last 2 slides here are economic. This is our economic confidence index for businesses, as I mentioned, also in decline, paralleling the national, but getting down to sort of a 0 at the state level, getting very close to 50 overall, but the national being the biggest component to drag down our overall index, and that actually went negative. So we have 6 components, 5 of them were positive, above 50, and the 6th component, the U.S. economy, businesses in Colorado are very pessimistic about the U.S. economy when we did this survey in December. This, again, will be something that you can look at. I do want to leave a couple of minutes for Q&A. You can look at in the future, but this shows the overall ranking of the state in terms of typical economic indicators. Very, very strong or positive in terms of most of these indicators, but I would draw your attention to the bottom line, FHFA Home Price Index. So the 5th highest in the last year, but if you go over to the far right-hand corner, bottom corner, we're number 1 for home price appreciation for the last 10 years in the entire country out of 51, including the District of Columbia. So this is one of the issues that has become a sticking point: housing affordability, building more affordable housing, housing for workforce, and so on. Big part of an important piece for politicians and others to address private sector. These are the headwinds. I've highlighted most of these already: interest rates and global growth. In terms of the state, commodity prices, drought, housing affordability, a very tight labor force, and then getting higher real wage increases. So with that, I think we have maybe 5 minutes or so to move on to questions. I thank you so much for joining. And Samantha, do you have questions?
Yes, yep, we have a handful that have come in. And just a reminder, if anyone has any questions that have come up during the presentation, you can submit those to the question and answer piece that you'll see on your Zoom interface. Also, thank you for those who submitted questions prior to the webinar. As I'm sure you heard Rich mentioned some of those in his presentation. So we'll see if we can get a couple of those answered too. So Rich, with given everything that you've mentioned, both corporate and personal health, but also accounting for the effect of the national deficit, do you think the tax cut was a good decision for the country?
Well, my comments on this are very unpopular. So I'm leading in with that. I actually believe, and it sounds like I'm out there campaigning for business, but the tax environment for business was not what it needed to be, and we did see a lot of repatriation. I won't say how the money has been used. Maybe some of that might be a little bit more disappointing, but we did see a lot of repatriation of profits, and I think that was a sign that the tax system here was non-competitive with some other parts of the world. That said, I don't think you could have passed that without passing a personal income tax, but passing the personal income tax was a financial disaster for the country. By far, the vast amount of taxes that are not being collected are at the personal income tax level, and to be having to do that and do it across all income tax categories is not something that I would have supported. So the answer is no. We got ourselves into this level of deficit because we decided to do a tax cut with an expanding economy. I was not supportive of that, but I want to make it clear it's totally a personal opinion.
Thanks, Rich. Appreciate
Yeah.
that. And then the next question, is there anything about continuing Colorado and Metro Denver population growth that will improve our quality of life?
Well, this is one of the issues. By the way, we have seen population growth that also goes further north to the Larimer and Weld counties have seen significant population growth as well. I think some of the infrastructure investments that have been made and continued infrastructure investments are going to be absolutely critical. I understand where people are coming from on this issue. When roads are more congested, we haven't caught up with the schools and so on. And then we had again, for the people who are not from Colorado, let me just say we had a ballot initiative, a sales tax increase that was voted down for statewide infrastructure investment in any sort of transportation, be it bike paths or roads or highways or whatever it might be. And I think that was discouraging to some people who believe that the growth has not, infrastructure has not kept up with the population growth. That said, we had 120 measures on the ballot, and if everybody's counting correctly, tax increase measures on the ballots across the state, 100 of them were passed that included tax increases. So it seems like we've been willing to vote at the local level for school bond issues and those types of things. We just haven't been willing to vote for increased taxes at the state level for whatever reason. And that makes me wonder how easy it's going to be to keep up with these infrastructure issues on a broader geographic scale, meaning not the city of Denver, but the metro area or whatever it might be.
Sure. Interesting. Well, more to come, huh?
Yes.
Yeah. Yes.
Well, I mean,
Always more to
I think
come.
there will be more to come. I mean, and it might be one of the things that the new governor, I know he's very interested in, has expressed a lot of interest in K through 12 education. There's also been some expression about transportation infrastructure types of issues as well.
Sure, sure. So I think we have time for about two more questions. I might need John, I'm going to ask you a question, but I might need you to clarify to make sure I'm asking it correctly. John is who submitted the question. So USDebtClock.org is forecasting U.S. unfunded liabilities increasing. Are we quoting $7 trillion per year, John? Just want to clarify there for the next 5 years. So, Rich, the question
Yes.
is, are they nuts with this projection?
No, I think they 7 trillion seems high, and I haven't looked at the debt clock recently, but it is a big number because of the demographic change. How many people are collecting Social Security on every day that weren't collecting Social Security, or on moving to Medicare and so on. So it really is a difficult situation, and I try to impress this on the students. Like, if there's one thing you should be thinking about, it's getting people who are actually looking at this debt issue, because it's the long-term health of the country. I mean, I would put out there, by the way, there's a bipartisan group called Citizens for Responsible Federal Government, or maybe it's Committee for Responsible Federal Government, but people should look at their website. And again, it's bipartisan. And they're really good about tracking all of these things and really trying to encourage more fiscal responsibility.
Good to know. Yeah, thank you. Okay, so we are at the 1 o'clock hour. Rich, do you have time for one more question before we take off?
I do.
Okay, great. So sorry, go ahead.
No, I'm ready.
All right. So the last question here. So it's been said that affordable housing could actually drive up the prices for surrounding housing. So I guess a two-part question. Do you believe that to be true? And then how do we balance artificially affordable housing compared to the larger housing market?
So this is not a simple question, but I think, or a simple answer. Let me just say that we've done some work in this area in the past. I think a lot of affordable housing programs ownership programs are somewhat more are limiting, or maybe even not good. I won't get into too many details there, but I am much more a proponent of a rental type of arrangement where the person pays a rent, some of which is put into an escrow account that would enable them to have a deposit for their own home at some point in the future. I think that the first part of the question is totally dependent on the locale. That affordable housing in a Denver market might be very different than affordable housing in a Boulder market, or an Aspen market. Those are very different questions in my mind.
Great.
Okay.
Well, thank you so much for taking the time to share all of this with us today, and for answering everyone's questions, both that they submitted before and during the webinar today. And thank you so much to everyone for joining us for today's presentation. And a quick reminder to view upcoming webinars that we have scheduled and to view previous recordings, please do visit our website at www.colorado.edu/alumni/webinars, and have a great rest of your day, and go Buffs!